Historically, when credit unions have tried to distinguish themselves from their bank counterparts, they focused on emphasizing their community-minded mission, their personalized services, and the lower fees on deposits and loans that they can generate by virtue of their not-for-profit status. Against the recent maelstrom at Signature Bank and at SVB, however, credit unions would be wise to stress some of their structural differences versus community banks in terms of how deposits may be a little more resilient in the credit union structure. Credit unions, in fact, are more likely to be able to gird themselves against the deposit runs that we've seen in recent weeks. I want to discuss four particular structural advantages that credit unions have versus bank structure. First, credit unions do not have publicly listed shares. What this means is that the credit union is likely less susceptible to a run that starts with a short seller taking an advantageous position in the bank shares and then creating a frenzy through social media. In recent weeks, there has been ample attention paid to the fact that some of these runs or mini runs have been fueled by a combustible combination of a short seller and social media. Credit unions simply are not susceptible to such an attack. Secondly, credit unions across the industry hold far fewer deposits that are uninsured. If you look across the credit union industry, you see that only 9% of its deposits are above the $250,000 insurance limit. Banks, on the other hand, have about 45% of their deposits estimated to be beyond the scope of federal insurance. Third, the consumer-oriented nature of the credit union loan book is of interesting advantage here. Credit unions tend to lend to mortgages and to new and used autos as their leading categories. Over time, these categories have proven more resilient and less susceptible to loss than the categories of some of the traditional bank lending. The smaller account sizes and the loan categories are a historical advantage for the credit union model. Our friends at KBRA did a recent study which showed that over the last 50 years, the credit union industry has seen a failure rate that is far inside that of community banks. In fact, KBRA suggested that over the last half a century, banks have failed at 0.65%, while credit unions have only failed at a 0.27% rate. Finally, credit unions have a unique capital structure. They are owned by their members, and they cannot issue equity securities. This means that their ongoing earnings are generated entirely for internal capital generation. This means that shareholder pressure is essentially non-existent, and this should result in less incentive to take on risk. Over time, we would expect the credit union to have a slower, more methodical growth process than bank counterparts. This, again, is an advantage if you're looking from a risk standpoint. Overall, these structural differences should benefit credit unions as they increasingly compete in a difficult environment to gather and maintain deposit levels. The American people are becoming more discerning about where they put their money. They're more discerning about the structure of the financial institution where that money is stored. And credit unions would be wise to emphasize the benefits of their corporate structure, the diversification benefits and smaller size of their accounts, their favorable loan composition, and their comparatively favorable failure statistics over history. Now it's up to the credit unions to make their case.